I do believe strongly that times of dislocations present opportunities. And you cannot spend your time, whether it's the Blackstone stock or any stock for that matter, to obsess with the volatility of stock prices. It's noise in the grand scheme of things. And that's the reason why I guess I'm not a trader. I'm a private equity person. We invest for the long run, and moments of distress, moments of uncertainty, my view, present more opportunities than challenges.
Hi, everyone, and welcome to KindredCast, where we shine a light on the people and ideas shaping our future. KindredCast is a production of Kindred Media, powered by LionTree.
Welcome to KindredCast. I'm Kenna, Managing Director with LionTree in London, and today we continue our exploration of private capital investing with Lionel Assant, Global Co-Chief Investment Officer and European Head of Private Equity at Blackstone. Lionel has been a key figure in shaping the private capital landscape in Europe, leading Blackstone's private equity presence here since 2012. During his tenure, Blackstone has rolled out highly successful strategies in private credit, tactical opportunities, infrastructure investing, secondaries, growth, and most recently, high net worth investing. His global co-CEO role involves him working in conjunction with business unit CIOs and group heads across the globe to provide additional firm-wide investment oversight across Blackstone's various private equity asset classes. Blackstone now manages over 1.1 trillion of assets globally. At the same time, Lionel has himself been leading transactions across a range of sectors, focusing on the firm's key themes, including digitalization of the economy. Lionel's leadership has contributed to Blackstone becoming one of the biggest private investors in Europe, driving growth, creating jobs, and generating returns for shareholders. In 2024, Blackstone topped the PEI 300 for the seventh time in a decade. Lionel was involved in the founding of Impetus, the private equity-supported charitable organization focused on improving the lives of young people living in poverty. Today, we'll hear about Lionel's journey, Blackstone's approach to investment opportunities, and his perspectives on future of private equity in a highly volatile and rapidly evolving global economy. Lionel, it's an honor to have you join us here today.
The honor is mine. Thanks for having me, Louis.
So Lionel, can we start by learning a bit about you personally? I understand you grew up in Paris in the French education system and studied at the École Polytechnique before going into banking.
Yes, I did. I did 6 years of engineering studies, a master's, and specialized in mechanics and economics, but mechanics was really my thing. And then when I was 24, I asked my brother, who is a corporate lawyer, to give me his advice on what I should do next, because I was hesitating between continuing my studies and doing a PhD or going into, to get a real job. And he said, "What do you want to do?" I said, "I don't know, except I don't want to build bridges." And he said, "Okay, let me introduce you to two friends of mine. One was a banker and the other one was a consultant." And I met the banker, and I thought the way he described his job, negotiating, until 3 a.m, helping CEOs and CFOs and companies redesign certain strategy, doing deals, sounded very attractive to me. And the funny part of it is I had absolutely no idea what the job entailed. I had no basis of reading a profit and loss statement, cash flow statement. Therefore, I showed up at 2 interviews of 2 investment banks, totally ill-equipped to answer those questions. And by complete luck, I got the job. And that's how it started.
Fantastic. So you joined Blackstone from Goldman Sachs.
Yes.
And it'd be really interesting to hear about what Blackstone looked at the time. We talked about the many strategies you have now. At the time, I guess it was just LBO focused, and the assets under management were a fraction of what they are today. It'd be really interesting.
It was a fraction. I joined in 2003, 4 years before the firm went public. The assets under management at that time were 27 billion, which is 1/40th of what it was end of last year, 1.1 trillion. And also 1/4 of what it was at the IPO, which was around 100 billion at the end of 2007. And if my math is correct, between the end of 2003 and the end of last year, the compounded return from 27 billion to the trillion one is close to 20%, which, matches perfectly the returns that, we're trying to achieve in private equity. But for the firm was different. It was, a smaller industry, a small firm. We had a handful of people in private equity, 40 to 50 people in London. We had other strategies. Real estate was there. We had a small credit business. We had a fund of hedge funds business as well. And we had an advisory business as well, which now has been spun out. It was different.
And then thinking about your role before going into Blackstone and so on, the 20 plus years you've been in the organization, you've worked on so many transactions that it's difficult to recall, which is the most special. But can you tell us about some of the more memorable ones and the ways in which Blackstone was able to deliver value?
Sure. I always start with a funny fact, which is not that funny for me, which is my first transaction was the best one in terms of returns. And I always joke that, it went down from there. For my first transaction, or the transaction I was involved with, we work as a team, obviously, was a company called Gerresheimer, which was, at the time we bought it, a mid-cap diversified packaging company in Germany. And we had a vision with the CEO and the team to transform it into a medical device supplier, which we did through organic growth, acquisitions, divestitures, and then IPO'd it 3 to 4 years after we did the acquisition and did amazing returns. But that one was quite special. There are one or two that come to mind. You remember the GFC, which was pretty brutal on the overall industry. Then there was another crisis that followed in Europe, where Europe had a run on some of the sovereign debt, especially in Southern Europe. And I remember I went to our investment committee in 2011 and I said, I'd like to buy that Spanish company. And the investment committee looked at me like, is out of his mind. There was a run on the Spanish debt. And I found that business with the team that was throwing a lot of cash flows, that, had a very attractive cost structure, that was doing tin plate cans in Spain, and that was exporting them all over the world with a hub and spoke model. The name was Mivisa. We could set up that business at, lower than 10 times on leverage free cash flow, which is, quite attractive. And the business was growing double digit. And, ultimately Spain was an advantage because the cost base there was much lower. And I ended up convincing the committee to do the deal, which wasn't, easy, but, which is fair enough. Again, Spain was going through a tough patch. And we, built some divisions in Ghana, Peru, and other countries, and the deal ended up being a real success for us. The last one, which is not a specific deal, is, as you can hear with, the Mivisa deal, I like dislocations. And when you have dislocations, I think it's time to be on the front foot as opposed to the back foot. COVID was the ultimate dislocation, where some of the businesses we had invested in basically were shut down. And we had quite a few, actually, in Europe and in the United States. And not happy with that, I basically decided with my partners that it was time to double down on some of those great themes, great businesses, whether it's travel, leisure, events, where we could buy some of the best businesses at attractive prices because they were shut down and because the owners at that point in time wanted an exit. And we bought Born Leisure, which is the caravan parks business, among others. We bought VFS, which is a visa processing business, or Signature Aviation, which operates, private jets, airports. And these transactions at the time of dislocation proved, I think, with hindsight, good deals, and because we did them at the right time.
So it's tremendous opportunity in these times of adversity.
Yeah, I think there's no question you need to have a discount. When you buy a business which is shut down and which is generating negative cash flows before you put any debt on it, you can't buy it at yesterday's value. But if you buy an asset which is top decile in terms of quality of business, and you buy it at that point in time during that dislocation at a reasonable value, unless COVID had lasted for 5+ years, which, was effectively the bet we're making that it wouldn't, you'll do fine with it.
Yeah. So then coming to one of the very big transactions you did, we have Adevinta. I'm very pleased to have worked with you on this one. Very exciting. So it's a 14 billion transaction, which is absolutely enormous, involving a number of national digital champions. Just given the size and the fact it's quite a recent deal, it's certainly in the portfolio, it would be great to get your perspectives on how you got confident enough to write a check of this scale and about how you see that business evolving.
Of course. There is some history on online classified at Blackstone. We bought a business alongside H&F called Scout24, did reasonably well with it, and I've looked at the space in a great deal of detail. We were teamed up with Permira way back when to buy the online classifieds division of eBay. We ended up losing that deal to Adevinta, and one thing leading to another, we stayed close to the situation with our friends of Permira, and ended up buying the business and did a public to private a few years later. I would say Europe in general doesn't have a lot of growth. The GDP growth is 1 to 2 on average over the cycle. And therefore, one of the things I feel quite strongly is you need to invest in sub-industries that, have tailwinds. Online classifieds is definitely one of them. For it starts with the, digitization of the economy, the consumer transacting, working, shopping more online is definitely a tailwind that, helps a business like this one. This is a business that grew double-digit percentage, which again, you don't have that many like that in Europe. That's a good starting point. Then the second point is it's not enough to buy something that grows. You need to do something with it. And we felt quite strongly that the business had two characteristics that, made it possible. The first one is you have real pricing power because you have national champions and high relative market share, which, is again, gives you that confidence that growth is here to last. And the other thing is it's 20 different online marketplaces that were under one roof, which we didn't feel was necessarily the right structure. And that roof ended up creating duplications of cost in some instances. And we decided to, instead of duplicating this cost, taking some cost out of that duplication and reinvesting it in product and marketing to accelerate the growth and to help these national champions even grow, faster. It's only been 1 year. I have a rule, which is typically deals, whether they work or don't work after 6 months. I would say if that rule is true on this deal, we're on the category of deals that will work because we've had a very good start, but it's obviously early days.
So turning to Blackstone as a whole, we talked earlier about the scale, the 1.1 trillion, the multiple different strategies. We'll go through them again. So TAC Ops, which you've had for a while, infrastructure investment, relatively recent, BXPE, which is the high net worth investing. Tell us a bit about the advantages of that scale and the diversity. And also tell us, from 1.1 trillion, where do you go? Is the next target 2 billion?
I'll answer the last question first, because I feel quite strongly that we need to put the things in the right order. The AUM is not an input, it's an output. And it's the result of the input, and the input is 2 to 3-fold. 1 is performance, 2 is innovation, and 3 is the way you achieve that performance. The performance, it starts, finishes there. If you don't deliver returns for your investors, they're not coming back. It's that simple. The reason we went from the 27 billion of AUM when I started in 2003 to $1.3 trillion is because of the performance. Therefore, that has to be the way to go. And in order to get to 2 trillion, which I personally have no doubt we'll get to at some point, the second thing is the innovation. You mentioned that when I started, we had a handful of strategies. Today, we have around 70 plus strategies around the world across 4 divisions. And these strategies have been created because our clients told us they had a need, and we created that strategy with our clients together, whether it's TAC Ops, whether it's infrastructure, whether it's growth. The vast majority has been created organically. A very small percentage have been, bought, but the vast majority has been created organically. And the last one is you need to do it the right way. We have an important brand name that we need to protect, but we also need to protect the different stakeholders, the management team, the employees, of course, our investors. And, in a world, which has a lot of complexities, where obviously private equity is often the lightning rod when something goes wrong. I think you need to be impeccable, and we try to be. Now, to your question, when do we get to 2 trillion? I don't really worry about that, because I know we will if we deliver on 1, 2, and 3. The second implicit question is, when you have so many strategies, do you have synergies, advantages of scale, or disadvantages of scale? And I would say the answer for me is unequivocally, you have advantages. I'll give you 2 concrete examples of how that manifests itself. The first one is, we have around 120 plus people in our operating team, 40 data scientists, the talent management team, some people dedicated to pricing. That team is run by a gentleman who used to run McKinsey technology team, which is half of McKinsey. Before that, the person who was Rodney's predecessor is Jen Morgan, who used to run SAP. She was the CEO of SAP. You cannot get the quality of these people, you cannot get that infrastructure if you don't have the scale. And that, I think, is the differentiator between one single mid-cap fund and what we've built today. And make no mistake, these people enable you to underwrite a deal. Once you own the asset, they're inside the portfolio company, and they prep the deal for an exit. All of this can only be done if you have that scale. The other thing that scale provides is data. We have around 250 portfolio companies between real estate and private equity, which we religiously track on a weekly basis. We then sit down as a senior leadership group every quarter. We interview our CEOs. We have KPIs on a literally weekly basis. And that gives you a pulse of the economy. That tells you inflation is about to go up, inflation is about to go down. CEOs smell a recession, the consumer is doing well, the consumer is not doing so well. And while I don't want to overplay it, when inflation went up post-COVID and then went down, we had leading indicators in our portfolio that helped us do that. You cannot do that, again, in a single strategy, one fund firm. Therefore, these are 2 concrete examples where I think the size is your friend. And maybe I'll give you a third one, which I think is quite topical because we've deployed a lot of money in data infrastructure lately. We invested in a business 3.5 years ago called QTS. QTS is a data center in the United States, which we took private. We've multiplied the size of the business by a factor of 10 in the last three odd years by putting a lot of CapEx because there is enormous demand from the hyperscalers to build data centers. This was originally a real estate and infrastructure deal. We've created so much expertise within that group of people that we've reapplied that expertise in other divisions. CoreWeave, which is, a distributor of GPU from NVIDIA, adding value to other hyperscalers, was a TACOPS deal where they underwrote $4 billion of debt. We bought the largest EPC for data centers in Europe called Winthrop. We bought AirTrunk in Asia, which is the Asian equivalent to QTS. The ability to have these divisions talk to each other and create that expertise that, enables not only one deal, but the ability for the firm to deploy capital in something that they have high conviction in is only feasible because you have scale and you have several strategies.
One of the, you talked about stakeholders earlier. One of the new sets of stakeholders is high net worth individuals, where you've brought up a strategy where you can access them or they can access you directly in your investing power, scale, diversity. Yes. Can you tell us a bit about how that strategy came to play? It's something where from a standing start 18 months ago, you now have $10 billion plus under management. So it'd be very interesting to hear what you're doing there.
Let's take a step back, if I may. We have 3 sources of capital, if you will, meaning the money comes from 3 sources. We call them the 3 I's: institutional, insurance, and individual. Historically, the main source was institutions, which is still growing very nicely. And these are the pension funds, the sovereign wealth funds. And this is how the industry grew from what it was 45 years ago to today. Insurance has been a latecomer, but has been present over the last 5 to 10 years, and have been actively looking for yield which is why you've seen them deploy money in direct lending, but also in some real estate assets. And this is a very, very fast-growing, source of capital. And the last one, which is the one you talk about, which is individuals, private wealth investors, is probably the most untapped of the three. Just to give you a sense of the numbers, we're talking about $80 trillion of assets, of which the penetration in alternatives is low single-digit percentage. Therefore, this, when you compare that alternative allocation to institutions are anywhere from 20 to 50%. Do I think individuals/private wealth investors will go all the way to 50%? Probably not. Do I think they'll go from low single-digit percentage to double-digit, possibly 20? Probably. And again, the base is 80 trillion, and that base is growing. Therefore, you've mentioned the 10 billion fund, but we've been offering products to this, qualified investors for the last 12, 13 years. And over the years, we've given them more products in more strategies, in real estate, in credit, more recently private equity, I'll come back to that, infrastructure. And that pool of capital today at Blackstone is about a quarter of the assets under management. Therefore, it's, north of 250 billion. The fund you refer to, which is basically a strategy that was started less than 18 months ago, is a multi-private equity strategy where we take all the private equity strategies we have, controlled buyout, tactical opportunities, infrastructure, growth, life science, you name it. What are the advantages of this? One, diversification. Two, the investor is invested on day one completely, as opposed to the drawdown, which happens over a 4 years period. The third thing that people probably don't appreciate is 90% of the companies in the world today are private. For when you have, as an American, your 401k, or as a European, the equivalent, and you have it in spiders, or in an ETF, or in the stock markets, you're missing on 90% of basically the companies out there. It's not only a shame, but it's imprudent. And the ability to have access to these companies alongside drawdown funds with multiple strategies is what we've tried to create.
So we shouldn't forget the main fund, of course. Can you tell us a bit about the strategies there, to sectors, geographies,
yes,
risk profiles, check size?
The main fund is one of our two flagship funds, which was there when I started 22 years ago. We have a similar fund in real estate, obviously. This is a controlled buyout fund at scale. We don't do minority deals, we only do controlled deals, and we only do deals of a certain size. The strategy is the same as it was 20 years ago. The only thing is the size of the deals, as the industry has grown, are just a bit bigger. What do we do with these deals? As I said, it's controlled buyout. It's mostly primary deals. We don't love buying from our large cap peers. As much as I'd like to think we can do a better job, the reality is there are less levers of value creation when you buy from one of your large cap peers than when you do a public to private of Adevinta, and you can take, a number of points of margins and reinvest it in the business. Therefore, it's large cap, control, primary buyout, with real operating intervention. I mentioned earlier our team of operating partners and functional experts who are creating value in the buy, but also in the monitoring. Therefore, they're going to go inside the portfolio companies, work with the management team, and implement the value creation thesis. This is the fund that has existed for 35 years.
So in your role as global co-CIO, you get visibility over what's happening in the US, investing in Asia, investing in Europe. Tell us about Europe. What are the attractions of investing in Europe versus the US, for example?
If I may, I won't answer the question as directly as you ask it, but I always say there are three pillars that are needed to make a good investment in Europe. The first one is growth. Europe has less growth than the United States, has less growth than Asia, and therefore, if you want to deliver the returns we're attempting to deliver, you cannot grow with GDP in Europe. You need to find a lane, a sector, a theme, a company that grows above GDP. That's the case of digital marketplaces. They grew at double digit. That's the case of energy transition. That's the case of data infrastructure. That's the case of certain software companies. For one is you need some growth, and therefore we will, as an investor, probably avoid a number of sectors. Sectors who have headwinds, we need sectors who have tailwinds. The second thing is everyone likes growth, but growth at a certain price. When we worked together on the public to private of Adevinta, we thought there was a moment in time where, the sector was fairly valued. As you know, most of the growth companies were overvalued in 2020 and 2021, and we felt at that moment it was not the right time to go in there. And the third one is, not only do you need growth at the right price, but you need a thesis. The thesis can be a lot of things. It can be buy and build, can be I'm going to have a very heavy operating intervention where I'm going to, reinvest in marketing and products, but take some other cost out. If you don't have a thesis, you're not going to make the returns that you're attempting to make. Therefore, Europe is a market, because it has less growth, I think you need these three factors to make a deal successful. If you don't have these three factors, it's not going to be unsuccessful, but it's going to be difficult.
So it's more about the thesis, it's about the asset. So are there particular industries or countries within Europe that you view as especially promising for growth?
I would say as far as industries are concerned, it's all about the growth, the tailwinds, the theme, the sector. A couple of industries that come to mind: digital marketplaces, online classifieds, energy transition, where Europe is a leader in the world, life sciences, where Europe is also one of the leaders in the world, data infrastructure. You may have seen we were in the process of building two very big data centers in the UK and Spain as we speak. For those are examples of industries and sectors where you have long-term tailwinds. It's not about the growth over the next 2-3 years. It's about the growth over the next 10 plus years, because we invest over the long term. As far as countries are concerned, I would say the bulk of the deal flow in Europe is done in 3 countries, which are in no particular order: UK, Germany, France. And therefore, you need to have a presence and a view as to when is the right time to lean in or lean out of these countries. At any point in time, you're going to have some level of dislocation, without even using the dislocation terms, but Brexit was one of them. We took the conscious view that it was the time to lean in because we could get very attractive assets at attractive prices. And, France and Germany have had their moments as well.
So one of the things that is a problem when you have such big deals is exit uncertainty. And it's a problem for many private equity sponsors now. About 40%, I think, of your assets under management are in perpetual funds. Tell us a bit about that, how you manage that exit uncertainty for scale transactions.
I actually think the number is closer to 25, but it still doesn't take the fact that, yes, the IPO market, especially in Europe, ebb and flow. Right now, for all intents and purposes, they're kind of somewhat closed, or they require a very heavy discount in order to IPO business. And by the way, that was before April 2nd. I would say the uncertainty that it has caused in the market has just accentuated that difficulty to IPO businesses. So I will say a couple of things about that. First, you need to be innovative. No one said you need to sell the business in one go. We have a business called Schenck Process, which is a manufacturing business in Germany. We tried to sell it in one go. Didn't work out. We decided to split it into 3 divisions and did extremely well with it. We found 2 strategics to buy the 2 biggest divisions. The second is private equity has one advantage, is you're not forced seller. There are moments of dislocation, as I said, where you feel it's time to buy. And there are moments where it's okay to keep assets. Now, if the IPO markets are closed for a long period of time, that creates an issue, but history shows that it's never the case. Therefore, yes, in our portfolio, we're going to have assets that the most likely scenario is an IPO. but we're going to have probably, certainly in Europe, where we tend to do deals which are slightly smaller than what we do in the United States, probably 80% of the companies we buy will not go public and will be sold, to either our peers or industrial buyers. Or in some instances, you're going to sell them to a listed industrial buyer like we did with Refinitiv and the London Stock Exchange. And you're going to own a small percentage of a listed company. Therefore, you won't have to go through the IPO, and then you'll sell your stock over time. Therefore, again, I don't think, the world is frozen. The IPO market will come back, and I think the industry needs to be slightly more innovative.
So you joined in 2003,
Yes.
4 years later. The business, Blackstone, listed at $31.
Yes.
And within 18 months, it had gone down 90%.
Yes.
So you've had, from an early stage, that experience. We talked about some of the other experiences after that, the sovereign crises in the Mediterranean. We talked about COVID. You've had a lot of experience of leading through times of extraordinary crisis. Tell us about that leadership and how you maintain confidence to invest in times that are very difficult, such as times we might be seeing now.
Our President John Gray has a motto, which is stay calm, stay positive, never give up. And I like it because ultimately at times of distress, dislocation, uncertainty, it's always time to reflect, not panic, and just look at the situation in the cold light of day. When we IPO'd and the stock went down 90%, the cold light of days we had 100 billion plus of assets under management that were locked in for 10 plus years. And fact of the matter is, our assets were growing. We basically had the opportunity of a lifetime to do deals at very attractive levels, which is what we did. And then the stock recovered to where it is today. I do believe strongly that times of dislocations present opportunities. And you cannot spend your time, whether it's the Blackstone stock or any stock for that matter, to obsess with the volatility of stock prices. You've seen after April 2nd, one day we had the stock markets down 5%, the next day we had it up 10%. It's noise in the grand scheme of things. And that's the reason why I guess I'm not a trader. I'm a private equity person. We invest for the long run, and moments of distress, moments of uncertainty, my view, present more opportunities than challenges.
And characteristics of winners in this environment, I'm thinking about sectors, markets, or companies.
I would say the perfect example we discussed earlier was COVID. You have a third of the economy that is shut down. You have the ability to buy some of those absolute prime assets at that point in time at a significant discount, as long as you have staying power, which is, help them go through the COVID period. This is the type of opportunities that people will say it's once in a lifetime. It's never once in a lifetime. There's always something else. GFC created other opportunities. We bought the debt of some of our portfolio companies at, very attractive levels. And no one else knew these portfolio companies better than we did. And that's how we created, very attractive capital gains, including on Hilton, which, in June 2008 didn't look so good. And then eventually turned out to be, I think, the largest capital gain in the history of the private equity industry.
Well, finally, I note that on top of your responsibilities at Blackstone, you find time to do things for people in the community around you. You were one of the founders of Impetus and a trustee for a period there. Tell us about Impetus and about Blackstone's work with the charity.
Blackstone was one of the several founders of a foundation called Private Equity Foundation in 2006, which we ended up merging with Impetus in 2013 because the fundraising was a bit more difficult at that time. Both foundations had the same purpose and were both private equity involved. The purpose was to help disadvantaged children to live a normal life, from toddler to young adults. And private equity was backing these two charities with the private equity model. I was sitting on the investment committee of the private equity foundation, where we would have CEOs of charities explain to us how they were going to make the charity more effective. And then we would track that what they told us they would do, they did it. And we would track these KPIs, which is not too different from what we do in the private equity world, except it has a social element to it. Therefore, we call that the social impact. Today, Impetus PEF, which was renamed in 2013, has been renamed Impetus because it's easier. And indeed, I got involved on the investment committee as a trustee, helping them raise money. I think we're, you and I, Louis, and the industry in general, extremely privileged people. And I think it's our duty to realize this and to give back in some form, whatever that form is. I don't think it's a nice to do. I think it's a must do. And I think all of us in the industry have to do something.
And a final quick fire. So, favorite book?
When I was a teenager, I was quite intrigued by a French writer called Albert Camus, the philosopher. And I've read pretty much all his books. And the book that marked me the most was The Plague. And The Plague was about, the plague in Algeria, in one of the cities there, where people died. And I remember that line where Albert Camus says, when he sees these children, innocent children, dying from the plague, he says, we need more doctors and less priests. And what he meant by it is, we can't wait for miracles. We need people to do their job morning to evening to try to save those lives, especially these innocent children. And I like this because when you're a teenager, obviously you're, thinking about, what happens when we die, like all these big issues in life. And I think that philosophy of do your job well, try to do good things, try to influence positively by doing your job day to day, I think is something that The Plague gave to me and that I apply to myself to this day.
Fantastic. Favorite TV show?
I'm not a big TV person, but if I had to choose one, probably Game of Thrones.
Okay, fantastic. And favorite song?
I'm more of a music person. Therefore, I'll give you more than one answer, if that's okay.
Please.
I think I've listened hundreds of times to two pieces of music, which you're going to find very eclectic. One is the Requiem of Mozart, which I think is by far the most sublime piece of classic music. I think it's fantastic. I could hear it, every day. And the other one is The Wall from Pink Floyd, which, is obviously quite different, but I think it's genius as well. But I recognize neither one of them are songs. For if I had to choose a song, I would choose a Lionel Richie song, Dancing on the Ceiling. And the reason why I would choose him is not because it's called Lionel, but because I had the privilege of meeting him one day. And I've rarely seen someone who is as authentic, has such a level of energy, and is such a good human being, despite being the superstar he is. And I think the way he sings, the songs he sings, bring enormous positive energy, and I love that.
Lionel, thank you so much for taking the time with us today.
Thank you very much, Louis. It was great to meet you.
We'd like to thank Lionel for sharing his insights into private capital investing and his experiences at Blackstone. His perspectives on global markets and leadership provide invaluable points of reference as we all navigate the future of finance and investment. We look forward to seeing how Blackstone continues to innovate under Lionel's leadership.
Thank you for listening. Stay tuned for more KindredCast conversations from leaders in business and beyond.